Welcome back, everyone. During this session, we will take a deeper look into our businesses, starting now with IG and Upstream, followed later by Downstream, Renewables, and Energy Solutions. Now, earlier we discussed our beliefs around the critical role of LNG in the energy transition, as well as the continued need for investment in oil and gas production to provide secure energy. We believe that our portfolio in both IG and Upstream is highly advantaged, positioning us for sustained value creation and for cash flow longevity. IG and Upstream together generated roughly 70% of our organic free cash flow last year, and we expect that they will continue to generate competitive cash flows for our shareholders. Our LNG portfolio is the largest amongst our IOC peers, where we benefit from significant cash flows that we can sustain well into the next decade and beyond, as we pursue a focused growth strategy leveraging our portfolio scale and its breadth. In addition to the strong growth that we expect in IG, we will continue to invest in our Upstream business, both organically and, where the right opportunities arise, inorganically, ensuring that it remains stable and resilient for years to come. Together, these businesses will provide a strong foundation for value creation. With that, let me start by giving some more detail on that portfolio strength. You've heard us talk about value over volume for many, many years, and this principle will remain at the heart of our strategy. We continue to have the highest CFFO excluding working capital per barrel of oil equivalent amongst our peers, consistently generating more value per barrel than any other integrated oil and gas company, together with very attractive returns on capital. We're well positioned to sustain this cash flow delivery with clear line of sight through the 2030s. This is underpinned by our resilience to a wide range of market conditions and our drive towards competitive, best-in-basin performance across our portfolio. And we're also driving lower emissions. Our portfolio has become more carbon competitive, demonstrated by the fact that we have reduced our carbon intensity by more than 30% since 2016. On to volumes now. We'll continue to grow our gas business, where LNG in particular plays a key role in the energy transition, producing fewer greenhouse gas emissions than coal when used to generate electricity, and fewer emissions than petrol or diesel when used for transport fuel. We expect to maintain or grow our oil and natural gas liquids production, aiming to sustain material liquids production of 1.4 million barrels of oil equivalent per day to 2030, supporting the demand for secure energy. Across IG and Upstream combined, we expect a total production growth rate of 1% per year through the decade, which is achievable at our targeted cash capex of $12 to $14 billion a year. In summary, our focus on value over volume and strong operational performance is delivering attractive returns, and we expect our leading IG and high-margin Upstream businesses to continue to do so for the foreseeable future. To show you how we aim to sustain this, let's dive just a bit deeper into our resource base. Our advantaged portfolio is weighted towards leadership positions in IG and prolific deepwater basins, which work alongside our resilient conventional oil and gas business to form an overall advantaged Upstream position. We believe we have the right portfolio, consistent with our beliefs on LNG and continued liquids demand. But what really differentiates Shell is the significant proportion of high-margin commercial resources, the largest resources in LNG and deepwater compared with our peers, both areas in which we excel and in where we can drive disproportionate value. And we continue to deliver on our commitments. We're on track to deliver our CMD 23 commitment to bring online projects with a total peak production of more than 500,000 barrels of oil equivalent per day by the end of this year, given over 80% was already delivered in the first 2 years. This includes 2 new platforms in the Gulf of America, 2 new floating production, storage, and offloading vessels in Brazil, as well as gas platforms in the UK and Malaysia. Importantly, these improvements have come alongside structural cost reductions of $1.4 billion. We've also simplified our structure and operating models, ensuring a more efficient organization and challenged existing business models with the creation of our announced new integrated joint venture with Equinor for the UK North Sea. So we start from a position of strength, and today we are showcasing projects that will add over 1 million barrels of oil equivalent per day of peak production, underpinning our growth and longevity ambitions, and providing resilience with an estimated break-even price of $35 per barrel. This growth will be driven by new gas supplies to existing LNG facilities and by maximizing output from our deep-water fields. We will bring on Sparta in the Gulf of America and expand operations in Brazil with an additional Mero FPSO, Atapu 2, and the recently announced Gato do Mato FPSO. Looking beyond this decade, we're confident that we can sustain these levels of production to 2035 within the $12 to $14 billion of capital allocated to integrated gas and upstream. Our organic investment hurdle of 11 to 15% IRR across integrated gas and upstream will enable us to continue to prioritize value over volume. And any potential inorganic activity will continue to be examined through the same lens. Let's focus now on our leading IG business. At CMD 23, we outlined a path to grow our LNG business, and that's exactly what we are doing. We have a large portfolio of projects under construction, and our acquisition of Pavilion Energy's LNG business last year helps boost our LNG trading capabilities and is expected to close soon. In addition to this, our investment in ADNOC's Ruwais LNG project in Abu Dhabi will be another major step to grow sales into the next decade. And we've also made good progress in areas such as availability, which we highlighted at CMD 23. Year over year, LNG availability has steadily improved. For example, in Prelude, we've improved asset availability by more than 25% over the past couple of years. And QGC in Australia delivered its best availability performance last year. These achievements reflect our evolving performance culture, with teams focused on where the value sits. So we've delivered a step change in performance, but we are also excited by the prospects that lie ahead of us. Our ongoing investment in equity liquefaction capacity will support further cash flow growth well into the future. First to come is LNG Canada, and we're on track for first cargoes to be shipped around middle of this year. All LNG produced at the facility from day one will be provided to Shell and the other joint venture participants. LNG Canada was designed with resiliency in mind, with energy-efficient natural gas turbines and renewable electricity from the British Columbia hydro grid, lower CO2 composition natural feedstock from the Montney Basin. Additional projects in Nigeria and Qatar are also set to come online in the next 3 years. Including our investment in Ruwais, these projects add 12 million tons per year Shell share capacity to the portfolio, increasing our equity volumes by almost a third from today's levels. And all of these investments are top quartile when measured on a well-to-loading arm basis, i.e. across production, pipeline, and liquefaction, such that collectively they will reduce the average GHG intensity of LNG that Shell sells to our customers. As we get into the latter part of the decade and beyond, our healthy funnel of options, including projects such as Oman Train 4 and a Phase 2 expansion at LNG Canada, as well as backfill opportunities, All of that will extract further value from existing LNG trains and sustain the cash flow longevity of the IG portfolio. There's no doubt the macro environment has been remarkable in recent years, but we believe our operational performance, ongoing investments, and attractive options for the future show a clear path to continued healthy returns and sustained cash flow well into the next decade, further solidifying our position as the leader in LNG. All of this gives us the confidence to reconfirm today that our LNG term sales trajectory will grow 4 to 5% at a compound annual growth rate across liquefaction volumes and third-party purchases until the end of the decade, with additional optionality to grow liquefaction capacity even further after 2030. As many of you will have seen in our most recent LNG outlook, when we look at global LNG supply and demand, we see demand for LNG increasing by roughly 60% by 2040. This is mainly driven by economic growth in Asia, electricity demand from artificial intelligence, and emissions reduction plans driving gas demand within heavy industry and transport. The long-term fundamentals of LNG, therefore, remain extremely attractive, and we are very well positioned to benefit from these fundamentals. We've built the portfolio to be able to capture this upside whilst also retaining optionality so that we can be dynamic in response to demand signals. New supply coming online in the coming years could lead to increased volatility. However, we see latent demand picking up at the $9 to $10 per million BTU level, with price-sensitive buyers switching to LNG in a number of markets, like India and China. Together, our portfolio depth, trading capabilities, low cost of supply, along with high conversion to term Brent-linked sales and limited exposure to JKM prices, bolster our resilience to global supply increases towards the end of this decade. As you can see, we have architected a leading portfolio in a growing and attractive market, which is also resilient through the cycle and supported by our unparalleled trading and optimization capabilities. And with that, let me describe those capabilities in a bit more depth than we have in the past. Our trading and optimization capabilities offer an unrivaled advantage across our LNG portfolio, given our scale, our footprint, and the optionality which comes with that. We're the largest publicly listed LNG market participant, and quite frankly, we believe we have developed the strongest LNG business model in the industry, with an unmatched capability to deliver gas to our diverse customer base where and when they need it. With supply coming from all the major gas basins and long-term sales focused on Asian growth markets, our portfolio is fully integrated with our trading capabilities, providing flexibility and optionality to match supply with demand. The strength of our LNG trading business was on display in 2022 and 2023, when we redirected almost 200 cargoes into Europe at short notice, whilst maintaining secure supplies to our term customers. With multiple supply sources and demand destinations, we can also manage exposure to shipping route constraints profitably and at short notice. And with LNG Canada, we have an asset that, when operational, will add advantage supply, connecting a very cost-competitive North American upstream gas basin to growing Asian demand. Our global trading capability across basins diversifies our exposure to pricing, regulation, and even geopolitical events, ultimately improving reliability for our customers and adding value for our shareholders. And we're also seeing new areas of demand growth which could scale into the future. For example, our world-leading position in LNG bunkering is enabling the development of the marine LNG market, which is set for significant growth in the coming years and provides a further opportunity to diversify the portfolio. In summary, our size, our diversification, our balance, and trading capabilities all provide an enviable platform from which to create value now and well into the future. Let me now hand over to Sinead to talk a bit about Upstream.
Thank you, Wael. So switching to our Upstream portfolio, which is focused around our deep water and conventional oil and gas, or COG, businesses. These businesses are highly complementary. Conventional oil offers price resilience, whilst deep water provides price upside with its high margin barrels. To differentiate ourselves, we focus on basin mastery, understanding the subsurface and geology in key regions like the Gulf of America, Brazil, Oman, and Malaysia. Our long legacy in these positions provides the ability to produce at lower costs and higher efficiency to ensure we remain competitive through the cycle. Additionally, we are committed to reducing the carbon footprint of our production, aiming for lower carbon intensity over time by optimizing power use. For example, at our Timi asset in Malaysia and Sparta in the Gulf of America. Compared with our IOC peers, Shell's deepwater business stands out for its scale, efficiency, and infrastructure advantage. We are the only ones with a leading portfolio or position in both the Gulf of America and Brazil, two of the highest margin and lower carbon basins in the world. This is balanced by our high-graded COG portfolio, which provides stable and consistent returns from cost-competitive and long-life assets. Over the years, we have focused and rationalized the Upstream portfolio. Today, we are generating 50% higher CFFO, excluding working capital per barrel, compared with 10 years ago, despite nearly 20% lower Brent prices. We intend to continue maximizing the value from our existing portfolio, whilst also positioning ourselves for continued strategic growth. And our leading US deepwater position in the Gulf of America is a great example of that. Value maximization and growth potential. Over more than 4 decades, we have built our position as the largest operated leaseholder and producer. And we continue to deliver more value from these operations by focusing on levers within our control to safely maximize production and cash from our portfolio. The barrels from Shell's US deepwater position have one of the highest CFFO, excluding working capital, per barrel in our portfolio. And we expect to maintain an average production around 300 kboe a day into the 2030s. We will deliver this by deepening our interest in existing assets, like our recent deal to acquire an additional working interest in Ursa, and continuing to develop around the most prolific basins in the Gulf of America, creating opportunities for tiebacks, like the Silvertip tieback into the Perdido host. And through these tiebacks, connecting new wells to existing infrastructure and strategically delivering additional infill wells. We've added an additional 25% of incremental volumes to our Gulf of America hubs. We've also seen a step change in controllable availability, increasing our facilities uptime by 13% since 2018. And we're building a track record on reliability too. We have seen 96% controllable reliability for the second consecutive year in a row, demonstrating sustainability of performance improvement and bottom line impact. Our well, reservoir, and facilities management, or WRFM, capability integrates a variety of engineering, drilling, and operations discipline to manage everything from data gathering and interpretation through to modeling and drilling. Not only are we top quartile according to industry benchmarks, but we continue to improve, which enables us to protect and grow our existing production, delivering some of the lowest cost barrels available. By flattening our organization and increasing operational performance, we've reduced unit operating costs by some 15% since 2018. Our focus on performance improvement over the past 6 years has resulted in a significant $1 billion uplift. Meanwhile, we keep learning. Our new projects are also more efficient, replicating and optimizing our designs to reduce costs, cycle times, and emissions. For example, our Wael platform in the Gulf of America replicated 80% of the topsides from the prior Vito platform, whilst also operating with 30% lower greenhouse gas intensity. Next in line is Sparta, which will replicate about 85% of Wael's topsides, with additional design improvements to reduce greenhouse gas emissions and intensity even further. So if we move from a story of pioneering to one of partnerships, let's look south to Brazil. Through a strategic relationship with a national oil company, we're unlocking value in world-class reservoirs through state-of-the-art technology, combining both global experience and local knowledge. We've built a major pre-salt position in the Santos Basin, partnering with Petrobras to develop high-margin, lower-carbon barrels across 19 FPSOs in operation today, and with 3 more set to come online by 2030. Further growth opportunities on the horizon should maintain significant liquids in Brazil, with production of around 380,000 barrels per day into the 2030s. This exceeds any of our IOC peers. Our Brazil portfolio features long-life assets with high flow rates, and as a result, these are some of the most competitive barrels in our portfolio on both operating cost and carbon footprint, bringing resilience through a low free cash flow break-even price. Shell has been able to bring our international experience and technical capability, especially in areas like WRFM and near-field exploration, whilst Petrobras leads with deep local expertise, subsurface understanding, and operational excellence. And as the Brazilian fields mature, we will bring our midlife asset experience from the Gulf of America to unlock the full potential of our joint resources. This partnership has allowed us to grow estimated ultimate recovery by 14% since establishing our position as the leading foreign producer in 2016, and to add 400 million barrels in additional resources. We'll seek to leverage these learnings from the partnership on our own Shell projects, including our recently announced FID on Gato de Mato. As our first operated asset in Brazil offshore since 2009, this is a great example of capital discipline and our philosophy of value over volume in action. After engaging with contractors and redesigning the project, we've now sanctioned an FPSO that offers an improvement of approximately 75% in MPV compared with where the proposal was 2 years ago. Conventional oil and gas business, or COG, completes this advantaged upstream story. This is a portfolio characterized by deep experience in countries with long-standing relationships. COG provides the foundation to sustain our material liquids production portfolio beyond 2030. We see strong and consistent margin delivery of approximately $18 per barrel, which is driven by low-risk oil and high-value gas assets. We've high-graded this portfolio over the past several years, exiting positions with limited running room or higher costs and carbon, whilst continuing to invest in positions like Oman and Kazakhstan that provide longevity in liquids and cash flow. We're also implementing new business models for later life assets, such as the announced joint venture with Equinor in the UK North Sea, which I touched on earlier. From this new business model, we will extract more value from our combined UK assets through an independently operated JV. We've also successfully divested our onshore operations in Nigeria, completing the sale of SPDC to Renaissance. This strategic move allows us to focus on our deep water and integrated gas projects, reinforcing our commitment to delivering value. So this is a journey defined by knowing our competitive context in each country and positioning the organization behind the levers that have the most impact on improving efficiency and increasing value, whether that be partnerships or business models, reliability, turnarounds, or WRFM. As we've seen in the past 5 years, the landscape of our business is constantly changing. However, COG provides commodity price resilience through much lower cash flow sensitivity, which complements our higher margin deep water business. And with that, back to you, Wael.
Thank you very much, Sinead. In summary, our focus on value over volume, improved operational and project delivery performance, and disciplined capital allocation have created a leading IG business, which we will grow, and an upstream portfolio that supports our ambition to sustain material liquids production well into the 2030s. We're committed to oil and gas and to delivering value over the long term from our advantaged portfolio of assets and differentiated set of capabilities, which we believe will drive longevity, growth, and attractive returns. Let's now move to Downstream and Renewables and Energy Solutions, or DSR, where we have made significant progress since our CMD 23 and see a lot of opportunity to continue on that journey. We have a portfolio of businesses that reside within DSR, which span both sides of the framework that we used earlier in the group session and across IG and Upstream. DSR brings together our customer-facing businesses, where we have leadership positions such as in mobility and lubricants, as well as our high-graded products portfolio underpinned by trading. They represent about half of the capital employed in DSR. These are attractive businesses, today with 15% return on average capital employed and offering cash flow longevity and resilience. We're proud of the strong progress that we have made during our first sprint and will continue to drive performance so that they can realize their full potential. On the other side, there are businesses representing a further $45 billion of capital employed, where more work is needed and where the returns are not where we want them to be. Starting with chemicals. Here we are repositioning our portfolio to unlock value and improve returns. In power, we are driving a strategic shift in our business, reallocating capital to areas of the value chain where we see higher returns and that leverage our strengths. That brings me to our low-carbon options, which together represent today around $5 billion of capital employed across low-carbon fuels, CCS, and hydrogen. We will continue to develop these businesses to provide a platform of options we are building for the future, but we'll do so with capital discipline, harnessing our trading capabilities and driving deeper integration across our portfolio. Across these low-carbon options and together with our power business, we will manage capital employed to ensure that we are deploying capital where we truly see the potential to create value in line with demand. Going forward, we will limit capital employed across these businesses to below 10% of our total capital employed, with dynamic capital allocation based on returns. Our integrated business model provides a competitive advantage to deliver both today and through the energy transition. Our DSR businesses form an interconnected value chain of energy products and solutions, one that is virtually impossible to replicate. But we have some portfolio reallocation ahead to fully maximize the benefits of this integration. We have deep customer relationships. We have the strongest brand in our sector. We operate thousands of assets, manage complex product flows, hold long-term supply contracts, and run extensive logistics infrastructure across terminals, depots, and tanks. And we have unparalleled trading and optimization capabilities. These unique strengths allow us to maximize integrated value and create competitive differentiation. They enable us to navigate market volatility, allocate resources to the most attractive opportunities, and ensure that every barrel, molecule, and kilowatt is generating value. Our integration also allows us to optimize value by extracting margin at multiple points, from upstream production to downstream sales and renewables. When refining margins are weak, the trading uplift and marketing margins can still generate strong returns. And last but not least, it gives us the strategic flexibility in the energy transition to shift capital to where the best opportunities arise. During our last Capital Markets Day in 2023, we acknowledged that performance had been below expectations in DSR businesses. A turnaround was required, and it had to be a significant reset, not only in terms of our strategic focus, but also across capital allocation and cost management. I'm pleased to say that we have made good progress over the past 2 years. In 2024, these businesses generated over $12 billion in free cash flow, the highest in several years, reflecting strong performance and disciplined execution. In marketing, we achieved the highest annual adjusted earnings since 2020 at almost $4 billion. All this despite the price environment being much less advantageous than the price assumptions that we used at CMD 23 when we set the $4 to $5 billion range in earnings. We've been disciplined on cost, delivering $1.5 billion in structural cost savings through both portfolio simplification as well as accelerated decision-making. Cash CapEx has been lowered by 1/3 to $8 billion, significantly contributing to the improved free cash flow performance between 2022 and 2024. We have high-graded the portfolio. We have exited assets and countries where Shell has had a long history. We have paused projects and raised the bar for investments. The past couple of years represent good progress, but there is so much more to do, and I'll hand it back to Sinead now to explain how we will deliver this in a lot more detail.
Thanks, Wael. Bless you. Although we are on the right pathway, we will continue to be guided by our principles of performance, discipline, and simplification, building on the progress we've made over the last 2 years. We are actively reallocating capital from lower return areas to businesses and markets where we have proven we can deliver and have clear competitive advantages. We will maintain our capital discipline and continue to drive costs down, and our simplification journey will continue with relentless focus on value over volume, high-grading the portfolio where we see the opportunity to do so. We expect our businesses to deliver over $15 billion in CFFO, excluding working capital per year, on average through 2025 through to 2030. And in a lower oil price environment, they will benefit from both their existing resilience and our ongoing efforts. At the same time, we will work hard to ensure they deliver returns above 10% by the end of the decade, including the low-carbon options that we are developing for the future. This improvement journey will be an important lever in driving up return on capital employed at the group level and also enable Shell to create more value with less emissions. To substantiate these numbers, let's look at some of our core downstream businesses, starting with mobility and lubricants. As mobility and lubricants' total addressable markets evolve, we believe our businesses are positioned to thrive and will remain resilient, even as traditional fuel demand declines in some areas. The expansion of premium fuels, EV charging, convenience retail, and advanced lubricants continues to create high-value opportunities, driving long-term profitability even as fueling, vehicle, and industry trends are changing. In response, we continue to sharpen our strategy and focus on value over volume across our global footprint. In mobility, we are transforming our retail and convenience stores into convenience destinations, catering to evolving customer preferences with food and beverage services, convenient EV charging, and personalized loyalty offers. In lubricants, we continue to invest in premium, high-efficiency products, whether for internal combustion engines, electric vehicles, or industrial applications. These offerings create long-term value in areas where we have market leadership and competitive advantages. Our goal remains to maximize returns, enhance efficiency, and unlock the full potential of these world-class businesses. We will achieve this through targeting strict capital discipline, prioritizing the most profitable areas of our portfolio, continuous high grading, and expansion of premium offerings. We will also continue to optimize our cost structure and selectively invest in opportunities where we see clear and compelling returns. With this in mind, we will spend 30% less in cash CapEx over the next 5 years versus the last. and we will be highly selective on where we spend this. In mobility, where we have a global footprint, 80% of our cash capex will be spent in 10 key markets where we generate the majority of our cash flows. Markets like here in the US, Canada, and the UK, to name a few. Additionally, we're expanding premium fuels and lubricants by enhancing high-performance products like Shell V-Power and Helix Ultra. This focus has already enabled us to increase our gross margin per barrel by around 50%. All this despite a conscious reduction in sales volume in pursuit of value when compared with 2019. So as the fuel value pool evolves, we see the potential for significant growth in premium fuels. Our premium Shell V-Power fuels are now one of the best-selling performance fuels on the market and are expected to contribute around 30% of our gross margin by 2030, with roughly 75% of our company-owned sites being either freehold or held under long-term leases, and with over 80% of these sites based in strategic, high-traffic areas with significant potential for convenience and EV growth. Our retail network is resilient and well-positioned for the long term. At the same time, while the EV value pools grow, Shell's EV-related gross margin is projected to significantly increase by 2030 as we expand our retail offer. We will flex investment to meet evolving demand. At our last CMD, we outlined an ambition to grow the number of EV charge points to 70,000 by 2025 and 200,000 by 2030. Having already achieved our 2025 ambition 1 year early, we will retire the 200,000 by 2030 ambition as we shift our focus from charger numbers to profitable growth. Beyond fuel, we're expanding our convenience retail business, offering a broader range of services that align with a potential shift in consumer preferences and increasing EV adoption. In food and beverage alone, we expect an 8 to 10% compound annual growth rate by 2030. Now let's talk about lubricants. Our Shell lubricants business is often underappreciated. Lubricants is a deregulated industry with highly specialized requirements and bespoke formulations. Our strategy is focused on growing our premium product offering, which delivers high margins, and we expect Shell's premium lubricants gross margin contribution to grow 50% by 2030. This growth is driven by three key factors: rising demand for high-value premium products that improve energy efficiency, continued demand for premium lubricants in internal combustion engine vehicles, especially in Asia-Pacific and the Middle East, and lastly, the opportunities of e-fluids for EVs, thanks to our strong OEM partnerships. This also extends to high-value fluids for EV battery and data center thermal management. As a company, we will continue to leverage and strengthen customer relations. We're investing in differentiated customer offerings, loyalty programs, and digital solutions to grow our customer base and total customer value. To 2030 and even through 2035, we expect margin expansion in convenience and e-mobility, as well as greater premium sales in fuels and lubricants. This will enable us to grow cash flow into the 2030s whilst keeping overall cash capex flat compared to 2025 levels, thereby delivering greater free cash flow. So to summarize, we are encouraged by the growth potential in our mobility and lubricants businesses, which we believe nicely complements the growth we see across our LNG sales and oil and gas production, and with a duration that's much like LNG, which will last well into the next decade and beyond. Now let me tell you about our products business, where our strategy will enable us to continue to deliver value. We have a highly focused, high-graded portfolio, which we aim to enhance financial performance whilst at the same time supporting the energy transition by repurposing assets where we can create greater value. This month, we shut down a crude distiller at our Rhineland refinery, repurposing the asset into a high-quality base oils plant for e-fluids and engine and transmission oils. We have reduced our refining footprint while more than doubling the average refinery capacity. Over the years, we've high-graded our refining portfolio, reducing our footprint from 51 refineries in 2004 to just 7 today, with the completion of the Singapore divestment expected next week. We will have 4 core refineries in the portfolio: Pernis and Rhineland in Northwest Europe, Norco and Scotford in North America. By harvesting non-core refineries for cash, repurposing them or disposing of them, we can focus on a smaller number of high-performing facilities that generate stronger financial returns. So what defines the assets we've chosen to retain? They share three key characteristics. First, their strategic footprint. We maintain complex, flexible assets with strong logistics located in key markets. Second, our assets are deeply integrated with Shell's trading capabilities, enabling us to maximize value where others can't. Trading provides a competitive edge, optimizes crude sourcing, product placement, and risk management, which enables greater flexibility and higher earnings. And lastly, profitable decarbonization. We are investing in decarbonizing our refining assets to ensure they remain competitive through the energy transition. In 2024 alone, we committed to projects that aim to reduce approximately 2 million tons of Scope 1 and 2 emissions. This includes major projects such as Polaris, the carbon capture and storage project at Scotford Energy and Chemicals Park in Canada, which will capture an additional 650,000 tons of CO2 annually once completed. The transformation of our refining business is deliberate, disciplined, and value-driven, resulting in lower per barrel costs and an increase in refining net cash margin, where we expect to be top quartile in 2025. Now to chemicals. Wael?
Thank you, Sinead. Let me start by stating that we believe we have good individual assets that are well run by a great team, and that there are parts of our portfolio that also possess competitive advantages. However, given our starting point, and in particular our lack of scale in some areas, combined with competing opportunities across the group for capital, we do not believe we are the natural owners of this chemicals portfolio. We remain open to retaining exposure through other constructs that will allow the business to flourish, such as partnerships. However, our intent is to reduce capital employed by 2030. This compares to what we outlined at CMD 23, where we said we would keep capital employed stable. We intend to take a regional approach in chemicals, maintaining capital where we can drive differentiated value between the US, Europe, and China, steering our business through the cycle. In Europe, our assets operate efficiently and competitively despite current margin pressures. In North America, Shell Polymers Monaca benefits from advantaged feedstock, while our US Gulf Coast linear alpha olefins business holds strong competitive advantages. Meanwhile, in China, we have a successful standalone joint venture with CNOOC, which enabled us to take a final investment decision this year on Nanhai 3 and the polycarbonates project. However, given the challenges in the industry, and in some cases to get the most value from our investments, as I said earlier, we may not be the natural owner of these assets. During Capital Markets Day 2023, we talked about a unit-by-unit review of our chemicals and refining assets in Europe, which led to the closure of several uncompetitive units. In view of persistent challenging market conditions, we will continue to high-grade and pursue closures where necessary. Furthermore, in the US, while we will continue to focus on optimizing returns from our assets, at the same time, we will be pursuing strategic and partnership opportunities. This has the potential to help us realize value and support our intent to reduce capital employed. In China, we will continue with our existing strategy, delivering the next phase of expansion of our joint venture and working with CNOOC to produce high-margin products sold locally. When looking at the entirety of the portfolio, we hope that our intent is clear: to reduce our capital employed in chemicals by 2030 and to reallocate that capital to more competitive options that we have across Shell. So I've just talked about our plans for chemicals, and that portfolio represents around $25 billion of the capital employed within the $45 billion that we mentioned earlier. Here we break down the remaining $20 billion that we intend to go after with the intent to substantially improve those returns. Power and our low-carbon options represent $15 billion and $5 billion of capital employed, respectively. However, ROACE across these businesses was negative last year, and today we are outlining plans to turn this around. This starts with constraining the proportion of group capital employed that these businesses will represent by 2030 to less than 10%. We believe that by doing so, we will create a much stronger, more resilient, and more profitable set of businesses and options. Constraining capital will mean that only the highest return projects will move forward, and we will flexibly allocate between these two areas. And whilst many of our low-carbon businesses remain nascent today, they're important options that will contribute to the future shape of our organization and our investment case through the energy transition. Let's start with power. Power remains the most rapidly decarbonizing part of the energy system, and as such, it plays an important role in our efforts to deliver more value with less emissions. Since Capital Markets Day 2023, we've been driving a strategic shift in this business to better position ourselves for success. We've learned a lot, and we therefore have set ourselves a target to increase ROACE from 3% in 2024 today to around 10% by the end of the decade. So how are we going to deliver this? We have three levers. First, we are pivoting our portfolio away from assets with infrastructure returns and more towards assets that support our trading strategies. This means we will prioritize investments in flexible generation, such as gas-fired power, large-scale batteries, and digital technologies. These are critical for our trading teams to manage risk and capture value in a system which is expected to be more unpredictable as the share of supply from renewables grows. We're already taking steps in that direction, as mentioned with the recently completed acquisition of the Rhode Island CCGT, but also evidenced through our Rangebank project. This is a 200-megawatt battery energy storage system in Australia, which became operational towards the end of last year. With these investments, our total flexible generation and storage capacity under management is about 7 gigawatts today, including positions in key markets such as the UK, the US, and Australia. Second, we will continue to high-grade our portfolio, divesting non-strategic assets like our home energy business in the US and our offshore wind positions in South Korea and the Philippines. We will employ a capital-light business model as we develop our renewable generation portfolio, making use of project financing where it makes sense and working with partners. This will enable us to maximize the value of our existing platforms. And lastly, given our rigorous focus on capital discipline, we will maintain a measured approach to growth to increase the share of productive capital. For 2030, we are setting a ceiling for capital employed in power of around $15 billion. Whether we achieve that ceiling depends on returns and capital allocation choices, which we will make between both power and low-carbon options. Irrespective of the quantum, our portfolio will look different as we reallocate capital to where we can generate higher returns, increasing the share of trading and flexible assets to about 80% by 2030, compared with around 50% today. A business model best described as trading-led, asset-backed. In addition to our power business, our targeted areas of focus in low-carbon options are within low-carbon fuels, CCS, and hydrogen. These are essential solutions for sectors that cannot easily electrify, such as aviation and industry. We're allocating up to 5% of group capital employed to develop these growth options, providing resilience in the context of the energy transition. They represent our option set for the future energy system, and align with areas where we have competitive strength. Let's look at low-carbon fuels first. Despite encouraging developments and green shoots in certain parts of the biofuels market, the fundamentals look challenged through a large part of this decade. This, in part, contributed to our decision to temporarily stop on-site construction at our HEFA facility in Rotterdam. However, our longer-term outlook remains positive. We want to build a profitable low-carbon fuels business for the future, and we will do this by leveraging our trading and optimization capabilities to grow sales and secure sustainable feedstocks. And we're starting from a strong position today. In 2024, we traded over 10 billion liters of low-carbon fuels and sold 10 times more than what we produced. In the same year, Shell also became one of the world's largest traders and suppliers of sustainable aviation fuel, with close to 20% of the total sales in North America and Europe. This was delivered due to our regulatory expertise, our long-term agreements with producers, and the strength of our customer relationships, together with strategic investments in logistics around key terminals and airports. CCS and hydrogen are different to low-carbon fuels in that these are even more nascent businesses. But we are making good progress thanks to our integrated positions and our technical capabilities. In addition to helping our customers decarbonize, these low-carbon opportunities will help us meet our own emissions reduction targets. They're important levers to support the decarbonization of our chemicals and products and integrated gas footprint, where most of our Scope 1 and 2 emissions are generated. In the future, we see potential for CCS and hydrogen to support the future of our gas business, with abated LNG and new fuels such as liquefied synthetic gas all playing an important part in that transition. But without strong regulatory incentives or carbon pricing mechanisms in place, these solutions are unlikely to become economical. We will, of course, watch demand and be ready to scale up if the right market signals present themselves. Irrespective of how the energy transition unfolds, we see further upside beyond 2030 across these low-carbon areas, but we're not baking any of this into our plan, given the current uncertainty in terms of the pace of demand growth as well as the regulatory frameworks. And to ensure that we can scale up quickly, once we do see conducive market signals for low-carbon opportunities, we continue to invest in new technologies and drive continued innovation. We have proven leadership in producing clean fuels. A great example is our proprietary GTL technology, which at Pearl GTL fully integrates the gas value chain across upstream and downstream. The products are a pioneering innovation which increase the supply of highly demanded liquid hydrocarbons, but also provide an alternative route for natural gas monetization. Today, we are expanding the value opportunity from this technology to a new suite of products, including immersion cooling, direct-to-chip cooling, and precision cooling. These new markets include expansion into cooling fluids for data centers, which address the growing power and computing performance demand from AI and high-performance computing applications. Liquid cooling fluids can almost eliminate the need for power-hungry air conditioning systems and dramatically reduce required floor space, making it easier to scale facilities, reducing total cost of ownership, and improving sustainability. And we're not stopping there. Our commercially proven GTL technology provides a flexible pathway to produce biofuels, e-fuels, or a combination of both from a range of synthetic feedstocks, allowing us to develop low-carbon options for the future. We're not new to this space. In 2021, the world's first commercial flight flew from Amsterdam to Madrid, fueled with certified synthetic kerosene produced by Shell from captured carbon and green hydrogen. Our researchers and scientists are working with our assets to extend this demonstrated capability into affordable production at scale. As we're bringing discipline and focus on our competitive strengths in our allocation of capital, we will do exactly the same as we allocate our technology dollars, driving value both in the short term and in the long term. So, let me summarize. We will deliver more value from our core downstream businesses through focus on value by executing a differentiated strategy, by enhancing our operational performance in terms of OPEX and CAPEX spend, and by reallocating capital to where we have conviction in above cost of capital returns. This is a continuation of our journey, and these businesses should deliver over $15 billion in CFFO per year on average from 2025 through to 2030. This is a 25% increase compared to where we were over the past 2 years. Key to the improvement journey is CAPEX discipline, where we will spend $8 billion per year to 2028. We'll invest in line with or better than our IRR hurdle rates of 12 to 15% in downstream and 10% in the renewables and energy solutions. We will grow in areas where we have unique advantages and where we see existing high returns among our core businesses. And we will optimize for value in both power and low-carbon solutions, harnessing the optionality that they provide. We are confident that we can achieve this, given both the strong progress that we've already made, as well as the credible pathways that we have outlined today. And with that, let's open it up for more questions. Mohammed, come to the stage, please.
Just gonna grab some water.
All right, thank you, Wael. Folks, you know the drill. We'll do it exactly as we did last time. One question each, please, or maybe two if we have time. And please state your name and firm. Go to this table at the front, please.
Thanks, Mohammed. It's Josh Stone here from UBS. I wanted to ask about your approach to recycling capital inside the organization and how you intend to balance M&A and divestments. And because if I look over the last 5 years, you've been a net seller of assets. So is that still the intention if you look to the next 5 years? If I look at your capital employed, it's down over the period. It's down even more if I consider the impairments. So have we hit the bottom of the capital employed for Shell? Do you think you should actually now start to grow it from here? And then second question, I wanted to challenge you a little bit on your low carbon fuel strategy. You said you wanted to wait for the right market signals maybe to add more capital to that business. But you know, we had the right market signals 5 years ago. The rug was pulled from the industry. We're still seeing the fallout from that now. So what would give you, say the regulation did come back, what would give you the confidence that you wouldn't have the rug pulled from you again? Thanks.
Thank you for those, Josh. Let me take the second one first and then invite Sinead to reflect on the first. I think we mentioned it in the speech, we've learned a lot. The fundamentals are going to be key. And so when we announced our Energy Transition 2024 plan, we talked about a critical element being the affordability of these alternative lower carbon fuels, and that the majority of our technology spend is going to be to bridge that green premium that we currently see. So there's two elements here. There's what we can continue to do to be able to reduce that premium. And by the way, that's why we like, for example, low carbon fuels, because as drop-in options, they are the lowest cost alternative for the carbon takeout that they bring. But they're still more expensive, which is why they need the regulatory help. So we need to do our part to reduce costs, and we need the regulator to do their part. A lot of this is about how much confidence we have in the policies. There have been policies that have been consistent and we have been working through in multiple regions. So this is about making bets, more selective bets, in the countries where we see strong fiscal situation, strong appetite by both sides of the aisle, as well as the population to be able to decarbonize. And those will be the opportunities which we will invest in. And so we will be very, very clear and selective around where those are within the capital constraints that we have set for ourselves.
And in terms of your question really around capital employed, and is this almost the bottom of it in that sense, the capital employed, it's a little bit of a difficult question to answer. And the reason I say that is if I look at what we're going to see happening, for instance, in upstream or even LNG as we get projects online, you'll start to see, of course, depreciation accelerating quite rapidly because they become productive. So it really isn't stable as it goes through. At the moment, of course, we've got capital employed quite high because, as you say, we're building and we have not yet actually delivered LNG Canada being a case in point, and you'll start to see that coming. You could say the same for Sparta coming through. Gato d'Amato will start, of course, building in terms of the capital employed before it comes down. So it's not a linear situation. Your point in terms of, but you're actually saying you're looking to reduce your capital employed in chemicals. We are, but we're still investing as you look at it across the rest of the businesses. And why we've said through by 2030 is we don't want to be rushed on any of this. We want to do it for value. So that's why there's not a linear answer to that. Of course, I model it out, but I'm very, very confident that it will vary year to year to whatever I expect it to be.
All right, we have a couple questions coming in via Lumi Online, so maybe I'll touch on one first. So we have Irene from Bernstein, Societe Generale. 2 questions. First question, the chemicals industry has been at the bottom of the cycle for a while. Should that cycle improve and normalize, as is generally anticipated? Is there a risk that you are reducing capital employed, perhaps at a low point? And then the second question from Irene is, the capital discipline is impressive, and with the enhanced share buyback at today's share price, your market cap may be 40% smaller by 2030 than today. Is there a risk that Shell is self-liquidating?
2 great questions. Thank you for those, Irene. Let me maybe take the first one, and then if you want to touch on the second one. I think on chemicals, important we again contextualize the sequencing of our journey. Over the past couple of years, the focus has been very much on ensuring that we are doing all the self-help we can. And there were 3 elements to that. There was cost, capital discipline, and making sure that we ramp up Shell Polymers Monaca to where it is today. We have more to do there, in particular on continuing to create differentiated grades, and we're well on that journey. But that was an important part of the sequencing of the journey. And what we're saying today is we are, in essence, going to look at opportunities to be able to create or unlock more value. We haven't said we are going to sell it, nor have we said we're going to take one route or the other. As Sinead just mentioned, we start from a position of wanting to be able to really look at all the opportunities to create the scale and figure out how we will monetize that, whether that is through partnerships with other strategic partners or other options which we will be considering in the coming months. So that's, I think, one part of it. I think the second part is to recognize that we are looking to reallocate that capital into high return opportunities. So back to this point around the key messages from this Capital Markets Day, we have to be able to be a lot more unemotional about where our capital allocation goes in pursuit of where we have competitive advantage and where we see a long-term trajectory for the business for us to be able to create value. And that's exactly what we're doing in this context.
Indeed. And thank you, Irene. Yes, capital discipline is certainly alive and well. That is across the organization, and we've got that healthy tension that exists. But back to almost a comment I made earlier, when I think about the financial framework, when we have that debate, we talk about protecting our dividend first, then looking at the capital we need to invest across the company. We're not in a position where we have to be capital constrained. We're in a position where we're choosing to be capital constrained. And if the businesses keep coming up with more and more ideas, we will keep reviewing those and look at allocating between them. The second part of that, so I don't feel constrained from that point of view in terms of capital investing in the existing businesses or in actually growing those businesses. In terms of the sort of what you're alluding to is the buyback of shares in terms of self-liquidating. Hey, if the price continues as it is, I'll keep doing the capital allocation. We'll keep having that debate, and we'll keep buying back our shares. So yes, we will continue to reduce those and increase the stake of the pie for those shareholders who remain with us. And of course, at that point in time, at some point in the future, there will be that DPS increase. That is very clear. Remember, we've already done it. We've already done 25% over the last couple of years as well.
And maybe the only thing I'd add to that, Sinead, as well. Irina, I keep coming back to that vision slide that we had. And the vision's clear. We know the destination we want to get to, and we will keep driving towards that destination. A smaller number of shareholders will enjoy some of the glory of the 2035 period, and that's absolutely fine. They'll be much richer than they are today.
All right, setting the bar high. Okay, I have a question over here. Please, Kelly.
Thank you. Paul Chan, Scotiabank. Wael or Sinead, in the power, you're going to shift to 80% on the trading and flexible asset. Some of the utility company, at least in the US and one of your peers, saying that CCGT right now is not economic to build and is cheaper to buy. Should we assume that, I don't know whether you agree, and if that's the case, should we assume that to shift it up, you're just going to, using the acquisition instead of organically going to build? And also that a lot of the utility company actually believe solar and onshore wind is probably the only asset you could in the near term bring to the market due to regulatory constraint and permitting and all that. Wondering that whether you believe in that, and if that's the case, is it too much saying that shifting 80% to just on the flexible asset? The second question, want to see if you can talk about the role of exploration in the longer haul for you. I think over the past several years that you guys have cut back quite a lot, and you also have not done as much of the Wang Wildcat on the frontier exploration than in the past, and whether that will remain to be the strategy, and what is that role in replacing your production or reserve? Thank you.
Let me maybe address both, starting with your second question, Paul. I'm not sure of the validity of the point around where we sit compared to others. We're still very strong in our exploration spend, but you're absolutely right. The majority of it is going into heartlands. Around 80+% of where our exploration money goes today is into heartlands. Not because of philosophical or ideological reasons, much more because that's where we have seen the best return on our exploration spend over the last 20 years. The wildcats have been much more challenged, and when you look at the infrastructure that you require to build it with our break-even price requirements, it's more challenged. But we are absolutely committed for a very long runway for our exploration programs in the basins where we have a particular competitive advantage. That includes, for example, the Atlantic, and in particular our strength across Brazil, the Gulf of America, the west coast of Africa, as well as key basins like Oman, Malaysia, Kazakhstan, where we have good knowledge. On your first question, I think it's fair to say that we will play to where the longer-term value pools are going to be. We are not, you don't see us building new combined cycle gas turbines. The move we made recently was exactly as you described. We bought the 600 megawatt facility in Rhode Island. Remember, we have a strong solar platform here called Savion. And what's interesting for us with our trading-led asset-backed strategy is that Savion gives us a very healthy pipeline of solar opportunities, which we hybridize with our top 3 leading gas trading position here in the US, that is underpinned with access to either capacity in CCGTs or in the case of Rhode Island where we own one. It is the hybridization there that we are looking for with the minimum amount of capex we can get. I'd leave that as one point. I think the second point I'd make is it's important to recognize that the power sector plays differently. In Australia, there's a very different dynamic to what we see here, and similarly in Europe. So it is much more of a local power strategy that we are implementing, with flex playing up in certain markets more than others. On balance, the 80% is what we feel is the appropriate direction and proportion.
All right. This table over here. See Martin.
Yeah. Hi, hello. It's Martin Ratz from Morgan Stanley. I just want to ask you sort of two things. So, if in this discussion, trading clearly plays a very big role, and if trading is a sort of 2 to 4% uplift to ROACE, then it's probably somewhere as a share of earnings more than a quarter, less than a third, on a sort of ongoing basis. Which actually, when you think about it, makes it one of the very largest businesses in all of Shell. So, clearly important. In your vision of Shell by the end of the decade into the 2030s. Would you like to see trading to become a larger percentage of the overall earnings mix, or will it still, by 2030, be broadly that sort of more than a quarter, less than a third that what it is today? And how large can it become, in your view, before it sort of starts to change the nature of the company? Because it's a bit different, of course, than all of the rest of Shell, which is very much centered around physical assets. That's one thing. And the other thing I wanted to ask you is, in a number of locations, like chemicals and refining seems very integrated. And in your effort to sort of restructure chemicals, swing the capital employed, are there certain constraints where you might want to keep the refining but not the chemicals? And like, what constraint does that put on you in terms of the ability to restructure chemicals?
Did you want to touch on that second question, Sinead?
Sure.
I can go for the first.
Yeah, so in terms of, you're absolutely spot on. In many places we have integrated sites, and you can see that whether that's in the Netherlands, or we can keep going through the different locations. You're correct that we look at them as two different businesses and then look at the value that we create because of that integration. And that's why we talked about the energy and chemicals parks in the past as well. So is it adding a constraint in terms of what Machteld will look at as she moves her business? She's looking at that across the different areas to say, where would I be disadvantaged if I were to separate these? But fundamentally, no, we can put in place long-term contracts, we can put in place different agreements, and that's exactly what we're doing, is looking at where are there interdependencies, where is there value created because of that, and how long can you do that? We have it in different divestments that we do, whether it's in Singapore, of course, we continue to have a long-term relationship with Singapore in terms of either supply or offtake. So that's part of how we typically do these. And of course, what we're talking about is, in particular in the US, looking at strategic partnerships. So we see the ability to actually blend them together.
Yeah, thanks, Sinead. Martin, a couple of points. I mean, I think maybe firstly, the philosophy of how we see trading and optimization. We definitely do not see it as a business. Right? We see it as a capability, a differentiated capability. And I just want to emphasize that because it's a capability that indeed is unified under one umbrella in the way we've structured the company. But that's to be able to really perfect risk management and put the right controls around it in service of different business outcomes. But trading and optimization fundamentally differs in a place like crude or products, where we are working on commodities and where we are essentially creating flow, versus LNG, where it is central to an integrated value chains with our customers, to a place like low carbon fuels, where the 10 to 1, where we sell 10 times more biofuels liters than we actually produce, means it is much more of a trading-led, asset-backed strategy. One of the refinements that we have brought today is a lot of those low-carbon options will be moving more towards that trading-led, asset-backed. So we don't start from a position of constraints, because we also recognize that each of these different businesses will have different market fundamentals at any one point in time, but we do not want to get into trading for the sake of trading. This is as much of an optimization game around the assets and the value chain that we have, with selective trading around that because of the insights we get with the broad portfolio we have.
Thank you. Let's just stay here on this table. Can we get Giacomo and Mike, please?
Thank you. Giacomo Romeo, Jefferies. First question, you highlighted how you are one of, well, the largest off-taker of US LNG, and this creates a natural position when it comes to North US gas. How comfortable you are with keeping that position, especially as we go into a material ramp-up of LNG in the US and increasing demand? Second question, you highlighted a lot of changes in the DSR organization and portfolios in terms of where you capital employed and cost reductions. What are the key pushbacks you're getting from the organization as you change your investments and your cost structure in these areas?
Thank you, Giacomo. Let me take the second one first and then invite Sinead to reflect on US natural gas. I said earlier, the last couple of years, it's tough when you have essentially moved the direction of the company towards this real sort of focus on the destination that we're going to with a very strong value lens. And I would say in the early days, there was questions around, is this the right direction to go? I'd say over the last year, I've seen a significant shift in momentum. Of course, success in the direction as exemplified by out-delivering on plans, by being able to meet promises, by seeing the share price strengthen, by seeing the net debt continue to go down. That's created belief. We were talking earlier on the side, and somebody said, this, you can be sure of Shell. It does bring out pride in people. It does bring out a commitment to the pathway we've set forward. It brings out confidence in our people. People at Shell want to remember what it is like to be number one again, what it's like to win. And I think if I would just reflect on 2 to 3 weeks ago when we announced the vision and the direction, the overwhelming positive response we have had for that, maybe the strongest that we have experienced in any of our webcasts, at least in recent memory, tells me that we have the organization fully behind us. That doesn't mean, by the way, it gets easier, but it does mean that we have the commitment and the passion of the organization, and that's all I can ask for.
Yeah, in terms of being the largest US off-taker of LNG, indeed it plays into our overall portfolio balance, and this is something where we get a lovely piece of work between Peter on the upstream side and of course Cedric on the integrated gas side. So what we hopefully showed you earlier today is the balance in our portfolio and showed the Brent focus in terms of sales and exposure that we have in terms of that. So we have Henry Hub exposure, of course, through the associated gas that Peter has through his deep water positions, etc. And we have, of course, Cedric trying to balance across the overall portfolio. What's really important for us is that we're not just balancing it in terms of one of their portfolios. So it's not just the integrated gas position, it's about across the whole of Shell. And that's where our trading capability comes into play, because they can see what Peter and the upstream team are producing. They can see, of course, what Cedric has as well, and be able to take that with the third-party sales. And that's what gives us the confidence to continue to actually have that position.
All right. I'm going to really make you earn your money by asking some tough questions. Actually, it alludes a bit to Michaela's question earlier on what we would be willing to do. So Anish Kapadia at Palissy Advisors asked the question, some segments like chemicals, LNG infrastructure, and marketing trade at an 8 to 12 times EBITDA versus Shell's trading multiple of closer to 4 times. Will you look at spin-offs or other inorganic structures to unlock value?
You want to address?
Sure. Look, where we start from, I think it's fair to say, is a position of just looking at realizing value on everything that we do. What we're very much focused on is in terms of ensuring that we really get the value out of each of our underlying businesses. And hopefully that's what we've talked you through. You can see what we're doing on power, we can see what we're doing on low carbon, driving the businesses that are doing very well at the moment, the upstream and integrated gas, to go harder, to go further, to deliver more than what they've promised at the end of the day. But what is also clear is that at the end of this, if we cannot extract the value, we will look at any opportunity to extract value. And hopefully you can see that in discussions, whether we're the natural owner or not of chemicals. We look at partnerships. We've talked about specific assets, whether that's the UK, and moving out of the North Sea after decades and moving to a JV structure, whether it's Singapore, etc. So we do look at each and every one of these, and we don't rule out any option as we go through. But what's really important for us is that the sequencing is right. For our shareholders to actually get value, we have to sequence this properly. And what we're making sure we do is we're delivering very clearly on these underlying businesses. We're turning them around. We're making sure that we get the maximum out of the performance, and we'll keep doing that. That's where it stands.
Okay, back to the room. Lucas at the back, please.
Thanks very much. Lucas Herman at BNP Paribas Exane. A couple, if I might, and I think they both pertain to LNG. And one other, which actually is just a clarification. You talked about the sensitivity, by the way, of to Brent in the integrated gas business. I think it being it looks like about $1.5 billion. Historically, that's been nearer 2.2. Is there a reason for the shift? You've just excluded GTL, or is that just a function of portfolio? But that aside, what I wanted to ask, too, forgive me, the first is I'm just wondering whether when you talk about trading, in particular in the integrated gas business, you end up doing yourself a disservice. Because an element of this is, we buy from Oman at, I'm going to just say, 10% oil. We sell to whoever, Jera, at 13% oil. That spread, which is very rateable, when you talk trading, is that spread included? Because, you optimize on top of that, but how? So it's just terminology and how you're using and how we should think about it, and as said, whether we end up putting a name to it that perhaps is not that appropriate. And the second thing I want to ask, you've been essentially, I would have said, short supply in many respects over the last 2-3 years in LNG as a consequence, not necessarily of contractually being or not having the contract signed for flow, but because Trinidad hasn't performed as expected, Nigeria hasn't performed as expected, Peru hasn't performed as expected. I could go on, but I won't. And so the volumes available to you have been less than anticipated. As we move forward and the new supply comes in, my question simply is, to what extent does the portfolio go long? And therefore, should I be more concerned about the exposure that the portfolio has to, I'm going to use the term spot markets? I hope those were clear, and I'm sorry for
Very clear. No, not at all. Thank you, Lucas. Actually, maybe a great opportunity to bring a different voice into the room. Cedric formally takes over as of 1st of April, but why not create a bit of a burning platform?
Less burning.
Thanks, Wael, and thanks, Lucas, for the questions. As always, very knowledgeable about our LNG business. In terms of the overall exposure, what you see there is actually the total exposure of both our LNG trading, marketing, and our asset businesses, including the JVs. So it will be a little bit different than what we've shown in the past, perhaps, in terms of the balance on both the buy and the sell side, and that's why you see that that balance in terms of exposures. But the key message, I think, also compared to the past, is that you can see that the majority of our exposure in the years ahead, as we see a lot of supply coming into the market, is mainly on the Brent side, on the sales side, and also that the kind of, again, as Sinead also said, if we look at it on an integrated basis, and the amount of the short exposure that we have to Henry Hub is perhaps also is less than what it has been in the past. To your second question, what we also show there is our exposure to JKM and other global gas prices, which is by proportion a lot lower, and that has to do with the fact that actually, if you look through, let's say 28, 29, we're quite well sold in terms of our sales position, and so we're not going to be very exposed into that time frame in terms of spot prices. Beyond, as we look out past 2030, we have the optionality to see okay, what do we do with our sales portfolio, and how much do we contract, as we continue to see what the dynamics is, and to what degree do we actually want to offer more exposure to gas prices versus Brent beyond 2030. But kind of that's the resilience part of the message as well into the next few years up to 2030 that we feel quite confident about the portfolio. Thanks.
Thank you, Cedric. And maybe just to close off on that, we've thought hard, Lucas, around how to characterize it. I mean, the trading, optimization, you're right. Within LNG, it is very much optimization based. We have a whole bunch of sales contracts. We have a whole bunch of offtake agreements. And then what we do is we lock in the spreads, and then we're always optimizing against those spreads. And sometimes, of course, we look at where the market is and take small positions here and there. But the strength of the LNG game is the optimization of what is an unparalleled set of longs and shorts. And I would hope that as we continue to show, and you saw the slides where we try to bring the full visibility of all those supply points, all the demand points, just to show the richness of what has been built over time and how difficult it is going to be for those who are trying to get into the space to replicate that now.
On the front here, Paul.
Thank you, Paul Sankey again. If I read slide 43 correctly, are you saying that you're going to take capital employed in chemicals to zero? Because that's one way of reading the slide, whereby you would either sell it or write it off. That's question one. Secondly, I know it's very difficult for you to talk about a legal situation, but is there any guidance on the dispute with Venture Global and in terms of when arbitration may yield a result, or any timing that ideas you could give us? Thank you.
Yeah, very difficult to give too much on the second one. I'll give you the first one, Sinead. You know, we continue to hold on to our position of the Calcasieu having already delivered, I don't know now, 400 plus cargoes. The facility running at or above nameplate capacity, and the foundation buyers who created the bankability for that venture not yet getting any cargoes. The legal process is ongoing. We hope to be able to have some readout from the arbitration in the coming months, so hopefully this year, and then we'll see where that goes.
Yeah, and apologies if the slide wasn't clear, but no, the intention is unlikely to be able to go to capital employed to zero, to wish to do so. What's our thought? The reason we didn't put a number out there, Paul, because we'd love to just put some data there if we could, is because it will be different, and we're actually exploring those options. So there's, you know, we look at it from a sort of a regional perspective. So if you look to the east and what we have with China, it's basically locally financed, local products being sold with a partner who knows how to build this stuff and manufacture it well. So that's well suited. You then go to Europe, and what you see, of course, in the Europe sense is actually just a really challenged market. You can see, I mean, I think there was something like 5 shutdown of different crackers shut down, or units shut down, not by us, but others, recently in the last couple of years. There, what we're looking for, Paul, is very much, number one, is just make sure we're the most competitive, and we're doing pretty well at that, and then looking at whether we want to stay or whether that will be with partners or a full exit. You then look to the US, and it could be different whether you go towards the specialty versus the polyethylene. And that's why we haven't given an overall number, but, you know, is our intention to sort of write it all off to zero? Absolutely not. That's not the way to do this sort of the value lens or to protect it. And why we've given ourselves to 2030 rather than doing shorter, you know, we tend to like shorter targets to make sure we deliver. It's just about where the market is. The market at the moment is, you know, fundamentally longer term, long-term fundamentals, great, but short-term, pretty challenged. And that's why we want to take a different approach to each of the regions, and that might mean different timing. And that's why I've not given this sort of the line of sight as to where it will go to. But thanks for the question.
All right, perhaps do one that's coming through online. Alejandro from Santander. 2 questions. First one, in M&A, what would be your preference for the upstream business? Greenfield areas or more mature basins? Second question, thinking about dividends versus share buybacks. Dividends give a strong message about break-even. If the valuation gap narrows, would you reallocate distributions towards more dividends?
Let me take the first one, and then if you want to take the second one. Thanks for the questions, Alejandro. I wouldn't start with a predisposition one way or the other, because at the end of the day, this is going to be based on value. And so the question is, if we're going to buy somebody's assets, what is the particular advantage we can bring? Are we able to create value by paying the premium dollar for something that is about to start up? Is it because we have a capability? For example, in the Gulf of America, what we see is our well costs are significantly advantaged compared to peers. Take Sparta as a great example. one of our peers left that asset because it was going to be difficult to make it commercial. We stepped in partnership with Equinor, and fundamentally transformed the opportunity by leveraging an existing host design, a set of infrastructure design on the back of what we've done for Vito and Wael. That is where, and by the way, we got that for nothing, for very, very little. Those are opportunities where we can bring competitive strengths to, for example, a greenfield opportunity. But we've also looked at Ursa, which was given before, and there we are the operator of the asset. There was an opportunity to deepen. We needed to find a price point that was sufficiently attractive for us, and that's what we focused on. And so we start from a very open-minded, pragmatic place with one delivery in mind. Can we actually enhance shareholder value, specifically through free cash flow per share accretion?
And on the second one, indeed, the topic of how you split your distributions, or the form of them, is always hotly debated. And of course, we get varying views across it. What I think is common is everyone is clear, keep giving more. That's certainly something that unifies all of our investor base. Where our investor base largely sits and where they're very supportive is that allocation of capital towards share buybacks at this price. And they're very supportive of that, particularly here. And therefore, what I'm looking forward to is us having this debate at some point in time where it's not the right value lens, that we will shift towards dividends. And what we've said is, from our perspective, we will continue to take advantage of that mispricing. We'll continue to buy back those shares. And those shareholders, as you said very nicely earlier, who are still with us will be able to take advantage of that. So absolutely, there's nothing dogmatic about this, that dividend bad, share repurchase is good. Far from it. It's just about very much deep logic around value, and therefore, for the moment, the share repurchases make sense. But yep, looking forward to having that problem and looking forward to having to reallocate.
The back. Thanks, Ryan Todd at Piper Sandler. Maybe a couple questions. First, on the structural cost savings, the guidance that you've given over the next few years, it's a little more weighted to the downstream and renewables segments. Is that primarily driven by portfolio impacts, or can you maybe talk about what the primary drivers of the structural cost savings are there? And then, as you talked about Brazil and Gulf of Mexico or America, you've got leading positions in both basins. The volume guidance, I think, to 2030 is maybe modestly lower in both basins versus current production levels. Should we think of those primarily as basins that you're looking to sustain? Or what could be possible drivers of incremental upside that's not in the plan? Is it more likely to be things that you just talked about, like with Ursa and Equinor? Or are there organic opportunities to do more there?
Let me touch on the second one and invite Sinead to talk about our structural cost reductions. What we are saying is we want to target at least sustainability of that production, and where the opportunity arises to grow it. No question. We like both of those basins. We think we are particularly advantaged in both. One, indeed, as a partner, the other one as an operator. And that's going to depend on both exploration successes, as well as in the context of Brazil, license rounds, getting access, and so on and so forth. But just to add a bit more to each of them, what's most attractive in the Gulf of America is we have today 14 outstanding zip codes, hosts that allow us to really go around those areas, and in particular with an administration that's going to open up further lease sales, allows us to pick up the leases that will hopefully keep those assets full for a long, long time, and potentially make some big greenfield discoveries as well. Take Sparta, which is the one that's going to come up soon in the 20K or 20,000 PSI, more advanced horizon. The Paleogene is relatively underexplored with great upside. So now that we have a host that is going to be sitting in that advantaged area, we will take advantage of it and continue to broaden our opportunities for exploration with the hope that we can grow our production. But what you have here is what's in our resource pool right now, rather than trying to bank on something we don't yet have. There are, by the way, a number of tiebacks to our Appomattox platform, to our Perdido platform, that are being executed as part of this. I think in Brazil, what is underappreciated is just how massive those fields are. The 2P field, we will run out of license on the current basis before we ever run out of resource. So there it is less about getting access to new resource and more how we support Petrobras in making sure we manage reservoir in the most appropriate way. We have a lot of experience in that in a place like the Gulf of America, of course, because we have late life assets. And so we hope to be able to bring that to supplement Petrobras's very deep technical capabilities.
Yeah, in terms of the structural cost savings, we start from a great place where we've sort of delivered 3.1 billion a year early from a 2 to 3 billion target with more to come. So the way it is outlined in the slide is certainly not meant to indicate more in one area or not. What it's meant to indicate is a huge amount of ambition to continue to deliver and to hit 5 to 7 and to keep going wherever we can beyond that. But specifically, where is it going to come from next? So there is an element of portfolio, of course. We've just announced, of course, the SPDC completion. So that's on the upstream side in Peter's portfolio. We've also, of course, commented earlier that we hope to close in terms of the Singapore divestment in Mactel's portfolio. Both of those will have OPEX savings that will play out, of course, as the year runs through and will be sustainable beyond that. But beyond that, what are we seeing? Downstream is hitting this hard. They are very much focused on changing their way of working in everything they do, whether it's the mobility business looking at just costs in general in terms of inventory, where they're sourcing it from, how much they hold, looking at in terms of where they spend on advertising. Are they getting bang for the buck from it or not? If they don't do it, and that's what David's focused on. And I can keep going through each of the businesses. When you look to the refineries, to the chemicals businesses, what those actual GMs or general managers are looking at is how do they make their business more resilient and cost competitive. And we had a lovely example, for instance, in terms of every time we take any of these plants down, the cost to get them back up again, of course, is painful. So when you have storms, etc., it costs us a lot of money. And Norco did a brilliant job of ensuring that it was up and running, that it stayed there, that it didn't have to take things down, and it had it through resilience on power. And that meant that not only were they the only ones actually producing when everyone else was down, they reduced the costs that everyone else was seeing to bring it back up. So this is not about cutting cost, unilaterally. This is about actually, in some cases, spending more money because you're going to generate more value. So you're going to start seeing a bit more of a mix of that, and we look forward to sharing more examples. But I am very confident it's much more of a move away from divestments and more towards actually the underlying running of this company.
All right. We have 5 minutes or so left, so let's make this the last question. And Wael, perhaps when we're done answering that, if you could come up and say a few words to close us out. By the way, for those of you who are joining us for lunch here, back of your lanyards, there's a table number. So if you could help us by sitting at that table, that would be much appreciated. Right, the unenviable task of who is the final question. Biraj, you're right in front of me, so I'll give it to you.
Hi, thanks for taking the question. It's Biraj at RBC. It's a specific one on mobility. So the kind of slides you put forward, you show a 50% increase in the gross margin in the last 5 years, and then going forward, it's a underlying increase in the gross margin in absolute terms. But if I look at the last 5 years in terms of kind of bottom line, that gross margin improvement doesn't look like it's come through in the net income number, at least. I know volumes are down a bit, but it doesn't look like the volumes explain the story. So could you just help me understand the gap between gross margin and net margin and why that would be different going forward? Thanks.
Super. Well, it's great to, again, put one of our colleagues on the spot, David, because he will be delivering that uptick. David.
Thanks very much for the question. Thanks, Wael. The story over the last 2 years, at least, has been that the gross margin you've seen has grown over 10%, and that's translated into a 20% earnings increase last year. So it's starting to come through as we're putting into effect the strategy that we started about a year ago, excuse me, which is focusing on a much more disciplined way in high-grading the portfolio, focusing on our route to market and our cost base, as well as Sinead have outlined, and also on our premium products. So within that 2-year time frame, we've actually grown our premium volume by over 10% and have grown our premium margin by over 35%. So I think what we're seeing now is that translation of that gross margin growth coming through to earnings with the 20% that we saw last year, and with the actions that we have in place, I'm pretty confident that we're going to continue to see that drop to the bottom line. Thank you.
Thank you very much, David. We've been wearing David out and losing his voice. Sorry, David. Look, before I close off, just to maybe take the opportunity to make a couple of introductions so that in the break you can meet up with some of the new members that maybe you haven't met. So maybe ask Peter firstly, if you could just stand up for a second. Peter Costello will be running our Upstream business as of the 1st of April, has been running our conventional oil and gas business, and is one of the strong ex-BG folks who joined the company and continues to be with us. So please look up Peter if you want to dive into the Upstream business. Machteld, who is taking over as the DSR president, has been running our chemicals and products business, and before that was leading our lubricants business. So all this portfolio is very familiar to her, and a big part of her role will be to be able to deliver the turnaround we're talking, which we are well progressed on. So please look to Machteld if you have any questions in that space. Cedric, I think we have already asked to say a few words. You know Cedric from his integrated gas role, and he will move in as president of integrated gas again on the 1st of April. Let me also, David, you have just been introduced to, so you know, and maybe Colette, if I can invite you. Colette moves in as she was running the Gulf of America as vice president. As part of the delayering, Gulf of America will move to report straight into Peter. And so Colette will be able to share with you all our plans for the Gulf of America, but also bring to life some of the aspects of the culture journey that we have been going on and some of the improvements that you saw on the chart. So please make sure that you ask her any questions you have. Let me close off by saying a few words. Firstly, to all colleagues who have dialed in online, thank you for your patience. I can imagine it's tough 3 hours to be watching on a screen, but particularly for colleagues around the tables here, thank you very much for making it. And what a difference 2 or just under 2 years makes. There was a big question, I think, around whether this management team, whether this company could live up to the promises we have made. And if there's one thing I really wanted you to go away with, was the message in the video. You can be sure of show. We are committed to delivering what we said we're going to do. We don't take these commitments lightly. We recognize the credibility of our colleagues. Our credibility as a management team sits on our ability to be able to meet the promises we have made. And so you will see us working our backsides to be able to make sure that we deliver on what we have said we're going to do. We also have momentum. Right? There is something around an internal catalyst that we see at the moment that we want to try to unlock. So our job is not just to deliver the plan. Our job is to be able to inspire our troops to be able to do even more. And it's within our reach to do that. We have unbelievably capable people, terrific businesses, and with momentum and confidence, we can do a lot more. So that's where our focus is going to be. You've seen us continue to drive the performance agenda. That is a key priority, and performance, discipline, simplification continues to be at the core of what we want to do and who we want to be as a company. You've heard us today talk about a second key element, portfolio, and how we want to reallocate capital to be able to unlock the full potential of that capital employed in our businesses. And thirdly, we recognize our shareholders have choices, both in our sector and outside our sector. And we want to continue to be able to make this an exciting story for you. An investment thesis that has an element of self-help in it, an investment thesis that shows you competitiveness, shows you resilience, and a company that is moving into its stride, irrespective of where the energy transition is going to take us. This is a company that you can truly be sure of. Thank you all for making the time. Thank you for coming in today. I look forward to seeing some of you over the next hour, hour and a half who are here in the NYSE. Thank you again to those who called in, and I look forward to engaging with many of you, if not all of you, over the coming weeks and months. Thank you, everyone.